Good morning. It is May 22nd, 2020. This is Kirk Spano, and I am coming to you from Milwaukee, Wisconsin. So I hope that you are having weather that's getting better like we are. Finally, it's going to be in the 60s today, maybe even 70s. Got a little gardening to do this afternoon and tomorrow. So hopefully, as we all try to continue to socially distance as best we can, given our work circumstances and other things we got going on, you find some good things to occupy your time. So, going to do a little coronavirus update, and then really discuss just some general ideas for investing. You saw a couple of my articles this week. I discussed the corporate bonds that the Fed is buying and why that's probably a pretty good place for some money in the for short-term to intermediate-term foreseeable future if you are looking to grind out a slightly higher interest rate. And also, we're going to focus over the next week on stocks that we're going to want to buy on any summer pullbacks. I am updating this reports pretty much weekly or every other week. So for those of you who sign up for a free library card at Fundamental Trends, I will have this report updated this weekend, including about 20 stocks that we want to focus on this summer. If you're a member of one of my services, Fundamental Trends or Margin of Safety Investing, you'll have the links to the charts and where the buy levels roughly are. So if you're just a free library card member, you'll know the names of the companies, but you won't know where we're buying them. So, become a member, and I think it'll pay off for you. Where are we at with coronavirus? Well, let's take a look at our compendium and our theory over the next couple of years. A lot of economic destruction this year. We're starting to see bankruptcies, as I've been covering in recent weeks. That number is starting to tick up, and you're really going to see a huge wave of bankruptcies real soon, and that's unfortunate, but it is clearly about to happen. Next year, we'll have lingering economic weakness as we finally, hopefully, figure out a way to deal with coronavirus. And I'm going to pull up a couple articles from Bloomberg and some other sources. Something that we have to really consider is that, as companies like Moderna or whoever are making their announcements about, oh, hey, we've had a little bit of success in the lab, we need to really grasp the enormity of the task to create a vaccine for coronaviruses in general and COVID-19 in particular. I suspect that they're going to pull it off because of all the resources thrown at this point. There are so many projects out there that rather than having, we've really given up on trying to cure the common cold, right? Which is one of the 7 known coronaviruses. And this coronavirus, though, is focusing such huge resources on it that I think there's going to be good outcomes, simply because we've, like everything else, accelerated the change to the work-at-home economy and the alternative energy economies, things like that. COVID has accelerated the pace of development for coronavirus solutions. You can mark this down. You want to bookmark this spot on the webinar. I'm going to make a prediction right now. I think we're going to accidentally cure the common cold as part of this research. And when I say cure, it doesn't mean that it'll never ever come back, but it means that when we finally start getting shots for this, that's going to be one of the side effects, is that, it really is going to be effective against common colds. So, we'll see an incredible downtick in the number of colds. So one of the questions we should ask is, oh, what would be the side effect for some companies? Well, certain companies that sell an awful lot of cold remedies could be affected. Now, we certainly have to wait and see if I'm right on that. But I think that the solution that they come up with, the vaccines they come up with, will not only focus on COVID-19, but the added benefit is going to be huge, um, reduction of cold cases. And again, it doesn't mean that nobody ever gets a cold again. It just means that the colds are less severe and less prevalent. So, as we take these shots probably every year, every other year, because we have learned that this coronavirus is already mutating. The second wave in China is apparently underway. Over 100 million households already under lockdown again, and we'll see where this all leads. But it is clear that a second wave is coming, and we should not bury our heads in the sand about that. We just need to hit it face on. And I would say to all the people listening here, I've had some interesting conversations with smart people, and one of them yesterday, if you follow me on Twitter, you see that I called him basically an idiot. Brian Westbury over at First Trust, the chief economist, and he's an Austrian economist, and you know how I feel about those guys. They're a self-congratulating bunch who thinks that they've discovered a new economic theory that we know has been disproven over and over again. These Austrian economists, it's just he talks on his Twitter feed about how Keynesian economists fear him. Man, I tell you what, I'll take Paul Krugman over this guy any day. He is a second tier economist, maybe third tier economist, who found his way into an ETF niche. That they trot him out there because he says things that are a little bit divisive, and he gets attention, but he's not a big deal. He didn't even know how to read the coronavirus and COVID data. I told him to go find a grad school intern and explain it to him. But there's a lot of folks out there who don't understand what's going on, and apparently a lot of it's clouded by ideology. If you just look at the data sets, which I'm going to show you a little bit of here in a second, you see that this is just a massive, massive problem. And the ice that the stock market rests on is very thin. And we'll talk a little bit about that when we get to the bonds. So in any case, this is my underlying ideas about what's going to go on. Lingering economic weakness in the next year. And I believe that the signs for stagflation are already here. I was just talking to a warehouse manager for a Kroger, and some of what we're seeing, just had somebody send me something about a takeout place that they went to. There was a 15% surcharge for meat because the price of meat went up. So I think we're at that stagflationary point right now. It's starting right now because we have seen enough supply chain disruption, particularly in food, but also other items, that we're going to see, because of reduced supply of certain things, prices go up. Ultimately, prices will probably stay up because of all the money that's being printed. So if you're an investor, at some point, assets will get pushed up again. But it will only be certain assets. This bifurcation of the economy between new economy and old economy, I think is going to continue to be more pronounced. Tech will keep doing, better and outperforming. Certain industries will do well. Your fourth industrial revolution focused companies that use machine learning, companies that really embrace new on-time delivery methods. They're going to do the best. and you're going to have new money solutions. Square is a company that we talk about. PayPal is a company that we've owned since the IPO. So a lot of things are changing. They're changing fast. Coming out of coronavirus is not going to be as fast as people want. Again, I tell you to compare this to 2008. This is a more severe contraction than 2008, and it's not going to come back as fast because we have to have the healthcare solutions first. Why? Federal Reserve Chairman Powell talked about this last week, and it's come up over and over again. If you go to my YouTube page, I'm starting to save videos there in a list of, things to watch. So, go ahead and subscribe to my YouTube page, because not only is it my material, but you can find the things that I've watched that I think are real valuable. And I will say, even on this webinar, go into your settings on YouTube, and you should pretty much always listen and watch everything in 1.25, unless you really are taking notes and you need to pause it or something. Because I know that I don't speak as fast as maybe as I should sometimes, especially on a Friday when I'm looking at notes and I want to make sure I don't make too many big mistakes. So anyway, by 2022, I do think the economy finally starts to recover. Will presumably, and again, these things are off the table if we don't get the health solution, but presumably we have health solutions by 2022, so people start to become more confident again, and that's really again what Powell and Druckenmiller and Gundlach and everybody's talking about, that I talked about a month ago, is, or 6 weeks ago even, in one of these presentations. Consumer confidence is not good. People are doing their own personal forms of austerity. Like I told you, I brought $400 and change to Arizona in March, and I still have some of that money in my pocket, in my wallet. It's 2 months later. So this is the spread of deaths from coronavirus as of 3 weeks ago. Here is your updated. Just want to take a look. Where's Georgia over here? Now they're becoming a bigger share. Ohio. So you have, as New York sees their death rate go down, or the number of deaths, not the death rate, but the number of deaths, we truly don't know the rates, right? So people who argue about, oh, look, we're testing more, and that proves that not as many people are getting it. No. A lot of people are getting this. And I've said all along that the death rate will be around 1%. It's never going to be 5%. But we knew as we tested more, we discovered more cases, changes, right, the equation a little bit. So deaths over infections, probably going to be about 1 in 100 people is dying. The problem is so many people are getting this, and especially since we're partially reopening economies, I am not seeing anywhere near universal. I mean, I'd say barely, right around half. Let's say barely a majority, but it could be less. Only about half of people are wearing masks indoors, and almost nobody's wearing them outdoors, even if you're sitting in a group at a table. So what the research has shown is that touching things is not a big transmitter of the disease, right? Because most people don't touch something that was just recently infected and put their hand in their face. But the aerosol component here, somebody coughs, somebody sneezes, somebody just has got a very liquidy way of speaking. Those people. They too much stuff comes out of their mouth when they talk. That's really the major transmission, is the liquid particulates that come out of people's mouths. So you want to be, far enough away that if somebody's talking, you don't get that little droplet on your cheek. I know you all know what I'm talking about. That one guy who talks and he gets a little too close and you get the freaking, the speck on your cheek. Hate those guys. One, they stand too close. Two, they're not dry talkers, right? It sounds like a Seinfeld episode. He's a stand too close wet talker. Those guys you gotta stay away from. And then even outside, and I'm guilty of this. I go outside and I probably get a little closer to people than you should based on what's going on, but you can't help it, right? You're going to go outside, and at some level we take our chances. But the indoor things, because of the way that HVACs work, they're not really sucking in a lot of air that's going to save you. You really ought to be wearing those masks, and we're just not doing it. And that's showing up in the numbers. So as more deaths occur across the country, we'll see this chart continue to change. And again, this is despite New York City showing great progress, down to about 273 deaths on the 19th. There'll probably be a couple more that trickle in to change the count, make it probably around 300. But that's, that's a tremendous improvement. The problem is that the infections are still out there. So they need to see this number get down to, 2 digits, preferably low 2 digits, and the infections get to the point where they completely turn over. So it looks like New York is probably 2 to 4 weeks away from getting a grasp on this, but the rest of the country isn't yet. But I think New York is a good model for what we can do, but we have to be realistic about these time frames. There's a lot of people in this country not realistic about the time frames. They think that 6 weeks was enough. It's not. We have a doctor who's a member here who said, look, it's a 12-week process. And I think that because of the rolling nature of this, it's longer. We've talked about how it's longer. And, not having the national shutdown that stuck for 12 weeks is probably going to come back and bite us. Up to 90,000 deaths, despite the improvement in New York, right? So that means that, we're seeing problems. So New York came down, right? You saw how New York came down. That's what pulled this down. And a week ago, I said these numbers are going to pop back up, and that's what's going on. So if you take a look here, the daily death count is not plunging like we need it to. I mean, you really need this number nationally to be, for sure, towards 100. We just don't want to lose 1,000 people or 1,500 people a day. My fear is that because we're not all taking this as seriously as we should, that this curve is going to bend back up and we're going to get back up to these levels. In fact, I think it's almost a certainty that we get back up to these levels, and then we'll panic and we'll figure out what to do. So this is a little bit older, but I like the visualization. There's an argument out there that deaths by COVID-19 are overcounted. That's complete bullshit. Deaths by COVID-19 or with COVID-19 as a complicating factor are undercounted. This has since been updated. So they pegged it a month ago as a likely undercount, and it turned out it was. But I like the visualization, right? So these are the reported COVID-19 deaths, but these are all the extra deaths against the average that we had in those time periods. So I wanted you to understand that, doctors have an ethical oath to do no harm and, to do their paperwork right. So, this idea that hospitals are reporting deaths just to get money, I'm sure there's a little fudgeability around the edges there, but the point, for the hospital, we don't care about giving the hospitals extra money because we've largely shut them down for other things. So as they come back online, and I know they are because my hospital system sent me an email, hey, we're open for appointments again. You can see, this is what was reported for COVID deaths, but these were all the extra deaths. Reported for COVID deaths, all the extra deaths. COVID, but all the extras. So presumably some of these were COVID deaths, and a handful of these were probably very loosely correlated. Somebody was already in hospice care and they ended up with COVID because of a nurse. Well, right, there's a handful of those. Maybe 1 or 2% of these deaths, they were going to die anyway. But the majority are, COVID accelerated somebody's death from decades to years in most of these cases. Um, so and I'll use my grandmothers. I have two 91 grandmothers, 91-year-old grandmothers who are still with me. And, the one is super healthy. I mean, just seriously, you don't take any pills at all at 91 years old. The other one's got COPD. Now, so the one with COPD, she's been kicking for a long time, but I don't think that she'll live to be 100. The one that's never taken a pill, she probably will live to be 100 if something like this doesn't get her. So, how do you weigh that? If my grandmother with COPD gets COVID and she dies, how much did that really accelerate her death? 6 months, a year, 2 years? That's horrible, and I'll miss her. And I don't want to sound callous, but I get the point that some people are making about that. It's overstated, though. Most of the people who are dying are people like my other grandmother, or other people in their 70s and 80s who have high blood pressure that they could live with for 30 years, or some diabetes or something else. A lot of folks are dying decades earlier than they should. So just because somebody's 70 and COVID kills them, you say, well, they have diabetes, or well, they had high blood pressure, or they had this, or they had that. Those are not terminal things, right? Medicine's come a long way. But COVID puts us in the ground for that. So, let's not be callous, and let's just not be jerks. We say, oh, they were going to die anyway. That's bullshit. And then we have all the kids who are having what look like are going to be long-term problems. So the other problem with the disease is that kids and younger people who are healthy, who get it, it's something along the lines of 1 in 25 to 1 in 50 are having some type of long-term impact. So let's not normalize this as, oh, it's just a virus, like Brian Westbury over at First Trust. I knew he was kind of a knucklehead for years. That's why I don't use First Trust ETFs. But I tell you what, the fact that he can't read data, he just fits it to his narrative. That's something that I've been telling you goes on a lot in my industry, and he's guilty of it too. Read the Twitter thread. I mean, I was on my cell phone, so I didn't have time to throw charts at him, but he's just completely wrong, and so are the other people. So I'm going to be updating this report, and everybody who signs up for the free library card can have it. You'll get the chart book for the ETFs, and then we'll get down to growth stocks for the summer pullbacks. And people who are members know what the thesis is here. We're looking for companies that are going on the growth side. We're looking for companies that are going to be added to the S&P 500 soon. So that is where I want to focus on any summer pullbacks. And I think that we may be seeing that. The charts and the technical indicators and the quantitative data are basically saying that the stock market rally is at a minimum very challenged. So unless we get spectacular news and the economy suddenly, gets that V-shaped recovery, we're probably going to get a pretty good pullback here. At least 2,700-ish on the S&P 500. That's probably where I would enter stocks that I have the highest conviction on, and I want to own for the long term because they are mid-cap growth stocks that are becoming profitable, going to get added to the S&P 500 at some point. What we have to remember is that because they are going to be in the S&P 500, they will be impacted positively in general because of the ETF money inflow that they'll get a part of by now being part of the index. But also, when there's major panic sell-offs, they'll get beat up too. So the perfect time to buy these stocks is going to be during an S&P 500 pullback, right? So that's what we're looking for. I, would love to get a retest to the bottom before the S&P 500 rebalances. They're going to rebalance sometime in June. I can't remember the date. I'll look it up. And I don't even know if they give an exact date, but they did put it off last time. And then they, in the middle, they actually did do 2 updates here recently, as a couple of companies dropped out. So as companies dropped out because of, I think one was a merger and one was maybe a bankruptcy, they replaced those. But as I covered in an article probably 2 months ago now, maybe 6 weeks, we're going to see at least several oil companies removed from the S&P 500, and there's several other companies that could also be pulled out. Barron's covered this last weekend, I believe, or maybe 2 weekends ago. 31 stocks don't meet the inclusion criteria for market cap. Now, here's something to keep in mind and understand, is when the S&P organization adds companies to the S&P 500, at the moment, it has to be, I think, $8.6 billion in size and market cap. Just because a company falls under 8.6 billion doesn't mean they're automatically removed. 8.6 billion is just when you become eligible for inclusion. So if a company gets added and they fall below 8.6 billion, S&P will give those companies, especially if they're profitable, time to recover their market cap before they pull them out. And I'd say, most of the companies that just fell below that 8.6 billion are not going to get removed. I think we're going to see 7 or 8 companies removed. Half of them will be oil companies probably. Could they be real aggressive and rebalance 12 or 13 or 14 or 15 companies? They could. That's not typically in their nature. And if they do, they're going to add even more technology to the S&P 500, which probably makes it a better index. So we could see the S&P 500 become a better index quicker than we expected, in which case it's a more viable ETF solution for people who want to own more than the NASDAQ 100. I would argue that the smart thing to do for S&P is to be aggressive and replace 15 or 20 companies. That would instantly make that index a better index, especially if it's tech heavy. And, I think they're already a quarter in tech. If they go to 30%, 35%, so be it. At some point, maybe they have to put caps on the same way they do with some of the international indexes. But I'm not so sure they need to put caps on the sectors at this point. And one thing to keep in mind is a lot of things that are called tech right now eventually will have to be moved into different sectors. For example, some of the tech companies that are really finance companies need to be moved into a finance basket. And alternative energy companies that are considered tech companies, they need to be moved over to energy. So I think there'll actually be a rebalancing and recategorization of a lot of companies that right now fall under the tech umbrella, but really they're just technologically driven new economy stocks that happen to be in the sector. So whatever sector they're disrupting is where they should be placed. They already started doing that with communications companies, right? They pulled several tech companies out of that sector, and they put them into the new communications sector. So now you have Google and Facebook alongside of AT&T and Verizon. Why? Communications. So they're not even calling Google a technology company anymore. They're calling them communications. Google's a hard one to categorize, but Facebook, clearly communications, right? But a heavy tech component. So they're just doing their best to place these companies into the sectors where they think they're causing the most disruption. take a look at a couple of the headlines. Let me try. There we go. You know, it looks like the recession is going to be as serious as I think. You know, it's starting to get into the big investor crosshairs. The V-shaped recovery is pretty much dead in the water, and you know it's becoming very, very clear. So I do think that this is probably the best article for you to go out and read right now over on Bloomberg. I'm going to download this as a PDF, and I'll put it in both chat rooms. But you know, does a good job of covering some of the things that I've been saying. So you know, one of the things they cover that they just mentioned in passing is, look, younger people are getting sick from this too. It doesn't kill them usually, but there's pretty significant damage to a certain number of people. The strokes are occurring in younger people from this. So they touch on the whole idea of confidence. There you go, confidence. And that's really what we're facing. So I drove around yesterday for about 3 hours. I just wanted to see what was open and what people were doing. And traffic was light everywhere. And I made a point of traveling during rush hour from about 3 o'clock until 7 o'clock. Traffic was light everywhere. Had no traffic problems. Went to a grocery store, you know, like one person per aisle. You know, there was nobody there. And people are trying to spread themselves out. So that's good. Restaurants, you know, there weren't many people sitting inside, but all the outdoor decks were being used, so that's good. So what we're seeing is that, you know, we're clearly adjusting behavior, but none of the places that I went to or saw are as busy as they were a year ago, and that's probably going to be the case because, again, over half of the population is serious about not getting this. You know, you got your third of the population that I think is probably not taking this as seriously as they should. And we're going to be stuck in this phase one reopening for a really, really long time. You know, you're starting this, you know, Ford had to reclose a plant this week. They opened it. Somebody tested positive. They had, you know, they had to trace the contact chain. And now they got people who are being told stay home for 2 weeks. So that's going on all over the place. Companies, I actually think the big companies are doing a pretty good job on this. So the contacts tracing seems to be getting driven by companies, which is interesting to me that they're being more proactive than the federal government. So, you know, we're going to beat this. We're going to control it. It's just going to take time. When do we get a vaccine? Hopefully next year. You know, people who think that we're going to have mass production of vaccine this year are just living in a pipe dream. It's not going to happen. Could we have several viable candidates by the end of the year? Absolutely. But the idea that we're going to have it, you know, finally approved and then produced, you know, because it takes time, and then distributed, you know, second half of next year is still, I think, the best estimate. Maybe we have a miracle and we're distributing it next summer, but I think that's pretty a long shot. So again, you know, things I said last week, reopening doesn't mean open, headlines this week. So a lot of places are not going to do that well. AMC theaters, did they declare bankruptcy already? I'm not sure, but if they didn't, they're going to. You know, Noah Smith, him and I don't agree on everything. I have talked to this guy via Twitter too a few times. But, you know, he makes some good points in here that, you know, we need some essentials, but a lot of people are going to hold back until they're confident that if they get it, they're not going to die or have a serious problem. right? So antivirals and treatments, or a vaccine down the road. The antiviral arguments that are getting made right now are just silly to me. Hydroxychloroquine, I think I said that right. The one that President Trump said he's taking. Look, you can take a look at any peer-reviewed data. It is a desperation drug that is not something that you want to take if you can avoid it. It has massive side effects. People with lupus, they're fighting one battle and then they have to fight the side effects battle. So this idea that we already have antivirals that are super effective and safe, again, just not true. Could it save you? Yeah, it looks like the anecdotal evidence is that about half the people that use it end up not dying. There's an improvement in mortality, but it's not a wonder drug by a long shot, and you usually have something else go wrong. So as we map this coronavirus outbreak around the world, you're seeing second waves start to hit certain places, or the extension of first waves, which is what I think is happening in the United States. China's got a massive second wave, like I said, over 100 million people under lockdown again. And it's in their version of the Rust Belt, right? It's in the manufacturing area. And why would that be true? And because it's happening in the Midwest, right? In the Midwest, we had a lot of essential industries that had to stay open, and people there got sick. Why? Because they're in close contact to each other. So those folks really need N95 masks. The problem is with, they're hard to breathe in for an extended period of time. But if you talk to any, construction person or anybody who normally wears an N95 mask, they make do. But it will slow you down, right? Just because of the way air intake works. So, ideally, you can keep your essentials going, right? You don't have the broken supply chains, but we're already seeing supply chains break down. So, I think that personal austerity makes sense right now. And really, while there's no panic, I'll tell you right now, there's not a panic right now, but it'll probably come back in the next 2, 4, 6 weeks, I think. And if it doesn't, maybe by fall. But at some point, the second wave comes, or people start to realize, oh man, we've extended this first wave, and then your Costco is out of toilet paper again. So again, I implore you, fill up your freezer with meat. Make sure it's not tainted. It doesn't seem like any problems have been with the food supply, but I'm careful about that stuff. Fill up your freezer with meat. Plant a little vegetable garden this year, and buy a lot of toilet paper. I'm not saying that it will absolutely be necessary, but again, better safe than sorry, right? And I know better safe than sorry doesn't resonate with everybody for some reason anymore, but better safe than sorry, I heard it from Grandpa, I heard it from my first landlord, heard it from my folks, heard it from uncles. Better safe than sorry. And that applies to your stock investing too. So let's get to that. Get rid of some of these other headlines. I want to read this. I haven't read that yet. I'm not a big fan of Musk personally. I just like what his company did initially. But I'm probably going to buy a Ford Mustang or a Toyota. I saw the Model Y driving around Milwaukee the other day. It was ugly. It was ugly. Didn't like it. I was surprised I didn't like it. So here's a chart that we've been following of the S&P 500. Different Fibonacci levels. I used the Fibonacci time frames to kind of figure out where things were going to go. Remember I told you that this morning might be the day that the S&P 500 topped. Let's take a look. I told you we were in the topping process. What was the high today? $29.48. And we talked about 294 being a major resistance level for the S&P 500. look how we're chopping right around this area, these Fibonacci's that I outlined for you. You know, where there's overlap in these levels is where your strongest resistance and support is. And sometimes you go through a whole zone where this is where you're most likely to climb the wall of worry, right? Not overlapping, but they're close. So you just step up like a ladder. And that's what happened, right? We stepped up like a ladder. And now we get to the point where these resistance levels are further apart, and then stronger. And now we're chopping around these two resistance levels, you know, in that 291 to 295 region. And we're having a hard time getting over. So you build your arcs to kind of give you an idea of, are we still on an upward bend? Or are we starting to turn over? And this is the one arc we drew out to May 28th, which is the end of a Fibonacci time zone. Fibonacci time zones don't always work all that well. I just use them to try to see if, you know, shorter and longer is really what I'm looking for. If there's anything that's coinciding. And I really think that the options expiration dates are more important, which, you know, it is interesting to me that we didn't get a huge reset of puts. So I showed you the chart in the last article that the put to call ratio really is blown out of whack. And we can check it again today live if you like. So I'm curious to know why there's so many calls out there and so few puts. Not a lot of people buying insurance. So as I told you in yesterday's article, I started to buy puts on the S&P 500 again this week, just a little bit, 1%. And if this market had rallied up to here, I'd probably really loaded up on S&P 500 puts. Now, this could just be a consolidation to another step up. So next week, we could jump really well. We could go through this support resistance level up to this major, huge resistance up around 310 on the S&P. So while I'm nibbling some S&P 500 puts here and some Russell 2000 IWM puts here, I'm aware that it could go up one more level. And if it does, I'll start to speculate on the short side up here. So right now, just small hedges. Up here, I would speculate on major downside, unless again, medical miracle, or the whole world started to recover all at once. You know, these are, you know, hopium type of scenarios, but you know, you have to evaluate it when the time comes. So if I'm you, right, or I'm just me, small hedges right now, have my equity portion of the portfolio down to 50%, but I have long dated covered calls written on everything. So unless the stock market drops, you know, towards 10%, I don't even lose any money, right? Because the covered calls will just lose value, but the stocks, right, will gain value, but the stocks will. Actually, let me say this right. So I sell a covered call on GDX for $5, and a strike price of say 35 out to the autumn sometime. GDX falls to 30. The value of the call also falls, which means that I can buy it back for way cheaper than what I sold it for. So until the stock falls or the ETF falls more than what I got in premium, I'm good. And in most cases, I'm getting, for these long dated covered calls, I'm getting way over 10%. So I can withstand a 10% correction pretty much without losing any money at all. And I still collect the dividends. So where I really would advise you to sell covered calls is anything that pays a dividend. Sell covered calls pretty much at the money, long dated. And accept that if we get a major rally, you don't fully participate. Right? So if you are in the hopium crowd, the FOMO crowd, the fear of missing out crowd, I would tell you need to get out of that crowd. But if you refuse, Nothing much I can do about that. I'm telling you, this is a weak market. This is a thin ice market. I told you the same thing in January and February. If you sold and trimmed and sold covered calls back then, you did really well. And in the middle of March, when we bought gold on that major sell-off, because we knew that it was like a one-off event, right? We knew that it was just because of margin calls. You know, you're up 50, 60, 70% on those gold stock positions, right? Bears make money, bulls make money, pigs get slaughtered. Don't be a pig. So I really am telling you, you need to engage in some risk management. Doesn't mean that we don't go up a little bit more. We might get that last puff on the cigar, but we might not. As I said, a lot of times, because people are, want to get that round number, right? Markets gravitate towards round numbers and Fibonacci levels. It just happens. Fibonacci numbers are natural, right? They're in nature. They happen over and over again across different things. Study Fibonacci numbers, and you'll just start running into, wow, this is just something that must be in nature and our psychologies. It happens over and over and over again. So there is value in this, and because so many people use them, that's another magnet, right? Because a lot of people use these, it's a magnet. So round numbers and Fibonacci levels are magnets. They don't always go to where you think they're going to go. A lot of times the market will, decide, well, everybody thinks it's going here, so we can beat them up if we get it close, but not quite. And then they don't sell, right? They don't sell if it doesn't get, right? A lot of people arbitrarily, well, if the S&P gets to 300, I'm going to start selling. So what does the market do? Gets close, but no cigar. So I think that this might end up turning over next week or in the week after. Like I said, the economic numbers, the COVID numbers probably are going to be bad. You're not going to see any signs of a V-shaped recovery, which is what the stock market was telling you was going to happen, right? Got the V-shaped recovery in stocks. That's the hopium for a V-shaped recovery in the economy. And as the news keeps trickling in that that's unlikely, stock market keeps jiggling along. At some point, somebody says something the market doesn't like, right? And bam. And remember, Warren Buffett has this outlook, Jeffrey Gundlach, Stanley Druckenmiller. And you go on YouTube and just look at the interviews right down the list. And your big guys out there are trying to tell you, hey, this is a dangerous market. So I just, for those of you who are still FOMOing, right? I don't want to miss that next 5% up. Man, you need some fogak, because I don't know that we're going to get all the way back down here again. But look at all those levels that we cut through on the way up. They'll be just as easy to cut through on the way down, and it'll be faster. It'll be harder to deal with in real time, right? When the market's dropping 1,000 or 2,000 points in a day, it's hard to deal with. Do some trimming now. Right, long dated covered calls. The VIX is very high. You're going to get big premiums. And you can buy them back in the future on a market pullback if you want to. On a market pullback, you can buy them back because the stock price goes down, which means that you can buy the calls back cheaper, and some of the time value is gone, which means that the calls get cheaper. So I really, really imploring you to write long dated covered calls. Anybody who's listening, write long dated covered calls. All right. So some of the bad things are out there. I did an interview with Seeking Alpha that I posted. It'll be in an article soon. Next week, we're going to cover energy because I'm going to update my long-term energy outlook, the peak oil plateau report that I've been updating pretty much annually. I'm going to do an update next week. So this is one of the dumbest articles I've read all year, right? I'm calling people out for just not knowing what they're talking about. This guy didn't know that Occidentals got like 40% of their revenue from natural gas, and he calls them a pure play, a large pure play oil company. Bullshit. They have 40% of their revenue from natural gas and CO2. right? So the debt that Occidental has is huge over the next 3 years, 21 and 22 and 23, lots of maturities. I think they're mostly front loaded too, 21 and 22. And the debts, just short-term debts, are more than the market cap. So they're going to have to refinance something in the order of $11 billion of debt over the next couple of years. He actually mentions it in here, to his credit. But, this idea that, Occidental is suddenly a great investment. No, you have to understand the way bankruptcies work is that the very largest shareholders actually do get something. It's the retail accounts like yours that get nothing. So if Occidental does a prepackaged bankruptcy or does a series of merger and acquisitions, Icon can get paid in a way that you can't get paid. And we don't know what he owns for bonds. So the interesting bond here is if you really want to make 7 or 8% on your money, you could buy Occidental secured senior loans, right? The highest rated first in line during a bankruptcy, get 7 or 8%. You're getting a discount to the par value by 20 or 30 cents. So for every $1,000 worth of bond, you're only paying $700 or $800. You have to talk to your broker and see where you're at. Double check to make sure you're getting the senior loans that are secured. And if they go bankrupt, all of a sudden your bond will be made par, probably, if you're senior secured. And then you'll become a new shareholder in the new company. Here's why that would be attractive. Because as Occidental, and maybe not even Occidental because they do have some bad assets, but some of these oil companies, if they suddenly were almost debt-free, all of a sudden they're really good companies, right? And the stock price will be too high on the new IPO, and the investors, the bond investors who prefer to be bond investors, will trickle out of the common stock. So you can either buy the bonds now and become one of the new shareholders. And I'm not positive that Occidental goes bankrupt. I think they're going to. Either that or it's, like I said, just a series of strategic transactions. But you could make your 7 or 8% owning some Occidental bonds. So if you've got $1 million account, right, and you can put, you can buy bonds in $10,000 tranches, this might make some sense for you. Where I would advise you to go instead is, again, I don't know why people didn't read this article. This article hardly had any readership. Is, better off buy a bond fund. I cover mutual funds here, right? And we covered a triple B exposure. The Federal Reserve is buying a whole bunch of triple B bonds. So the corporate bond funds that have triple B exposure are really attractive right now because the Federal Reserve is propping that up. So when you think about quantitative easing, it doesn't automatically go into the stock market. The quantitative easing that we did during 2009, 10, 11, 12 went to the primary dealers, which are the big banks, and then they loaned that money out a lot of times to hedge funds and institutions that were going to buy stock. That's not what's happening right now. The money is going into the bond market to prevent our corporations from going bankrupt. So the idea that the QE is super strong with the stock market is just mechanically wrong. The money is going here. And to a certain extent, high yield, right? The fallen angels. So stocks that were triple B that became junk, some of those are still eligible for the money from the Federal Reserve. Here are the 3 ETFs that I'm using, right? The iShares investment grade corporate debt. I think it's the biggest ETF out there now. 46% triple B. Very little high yield, presumably fallen angels, right? Because their mandate is investment grade. So that means that they have a small amount that fell out of investment grade, fallen angels is what they're called. And they're getting fed money too. So probably half of the exposure in this fund is getting supported by the Fed. If you want to be more aggressive and get a higher dividend rate, you go to the high yield and then this Van Eck Fallen Angels. So the Van Eck Fallen Angels is really, I think, in a pretty sweet spot because they're specifically targeting bonds that the Fed might, um, support. So it's a higher risk play. These high junk bonds are always higher risk. It's almost equity risk, but this is where the Fed money is going. So I think that if you spread your money out across these three funds for about 15% of your asset allocation, I don't even think it matters if you're a growth investor or an income investor. Kathy, I know you're out there. Sell some stocks and buy some of these because you'll get your dividend. And that's what you're focused on, and this will be way safer than some of those stocks. So you take a look. You say, okay, and maybe I put 5%, 5%, 5%. Or I skip the high yield altogether and I go 8% and 7% or 9% and 6%, but about 15%, 16% right there. The reason being is when you think about asset allocation, we know that the 80-20 portfolio is a pretty common idea, right? So the 80-20 portfolio, maybe I talked about it in this article. Asset allocation of bond funds. Here you go. So historically, an 80-20 portfolio does about as well as a 100% equity portfolio if you're rotating your bonds into the better bond sectors at a given time. So when interest rates are high, you go into government bonds, and then you make capital gains as the interest rate comes down. The opposite's probably going to happen in the future because as we normalize interest rates, which we will, because eventually we'll just do helicopter money, and that will necessitate higher interest rates to prevent more stagflation, you'll want to be in certain types of bonds. And you don't want to be in government bonds ahead of the normalization that will come as a shock to most people. But it'll happen. At some point, we'll just print the money to bail out the debts. And, the Federal Reserve Chairman talked about it on 60 Minutes. I mean, it's not like this is some super secret idea that I made up. This is people at the highest levels talking about this. So I think an 80-20 portfolio is probably where most people should lean right now because corporate bonds are attractive right now. You're not going to make a ton of capital gain, 5 or 10%, but you'll collect a nice dividend. So for those of you who would be inclined to get 100% equity at some point, and if you're younger, you should head in that 100% equity because you make a little bit more and you have more chance to hit a home run. And the home runs, like Peter Lynch said, you just need a few of them to be home runs, and then that really, really helps you. That's not exactly what he said, but that's what he meant. If you're a retiree or pre-retiree, having about 20% in bonds and cash, pretty much always, right? Not excess cash, but a few percent cash just because that helps you with your distributions and cash flow on those, and then middle to upper teens in bonds. Right now, you should be in corporate bonds. You should really own like zero government bonds at this point, because the big gains from TLT and the other government bond indexes have basically been made. Could you squeeze a little bit more out if they go to negative interest rates? Sure. I don't think the United States is going to see negative interest rates, though. I think that there would be a major uprising if we went to negative interest rates. I don't know why the Europeans tolerate it. It's a bad theory that doesn't work. We know that it doesn't work because we've watched them do it. And, think about all the folks who keep, money in the bank. That's, a lot of people keep money in the bank. Again, we won't go too far into the wealth inequality, but most people with money in the bank, you've got that group of retirees who like to have a couple years of expenses in the bank, which I think is a great idea if you're older. If you're younger and still working, maybe you need 6 months in the bank. But, if you can have a portfolio where you dramatically cut your volatility because of the non-correlation between certain assets, and suddenly these bonds are not really correlated because of the Federal Reserve support, right? Once the Federal Reserve support goes away, they become more correlated again. But right now you're getting better diversification. And I think that the portfolio that most people should be working with right now is about 60% equities, not all of it invested, and then 40% split between bonds and gold stocks. Why? Because I showed the correlation chart, right? S&P 500 and QQQ, GDX is not terribly correlated. See, 0.13, 0.16. QQQ to QQQ is 1. QQQ to SPY is 0.94. That's 94% correlated, meaning that they move the same direction of the same magnitude roughly 94% of the time, or 94% of the moves are the same. I probably am not saying that just in the most understandable way. So if QQQ moves 1%, then SPY will move 0.94%. That makes sense? All right. So these bond funds are not the most correlated. And this LQD is the safest one, lower interest rate, but the safest one. And I think is going to do pretty well for a while. It's going to close at 5 to 10% discount to par. The high yield, though, this is the typical correlation, right? Remember I said that high yield is very close to equity, but right now, because the Fed is buying a bunch of those bonds on the fallen angel side, this correlation is probably lower by an order of magnitude based on the amount of bonds that the Fed is buying. So you want to be a little bit in the high yield. The triple B is really the sweet spot. So if you're more risk averse, right? If you're willing to take less risk, this is the place to go for, I think, pretty good hunk of your money. The Fallen Angels one didn't have enough time to fit on this chart, to be on this chart. It needed 5 years of history, and didn't have it. So the high yield, the Fallen Angels is probably somewhere between these two and probably closer to the high yield. So there's your asset allocation. All right, I'm going to stop recording here and then we'll do the private question and answer.